There's a $2.5 trillion market almost nobody can see. It funds companies, shapes your economy, and quietly holds your retirement money. So here's the real question nobody asks. Whose money is actually in there? Private credit barely existed in 2008. Today, it rivals the junk bond market. And it grew fastest, exactly where regulators stopped looking. Think of it as a bank with no branches, no tellers, and no rulebook. To see the danger, follow the money upstream to its source. Here's where it gets interesting. Private credit is just a middleman. A fund raises a giant pool of cash, then lends it straight to companies. No deposits, no branches. Just investors on one side, borrowers on the other. The fund keeps a fee for standing in the middle. A software company needs cash. Its bank says no. A private fund says yes. But be honest with yourself. That yes usually comes at a much higher price. So who hands the fund that giant pool of cash? This is the part the headlines skip. Meet the real lenders. First, pension funds, the retirement savings of teachers, nurses, and firefighters. They manage trillions, and they need steady returns to pay people for decades. So your pension check may be funding these loans right now. Second, insurance companies. The premiums you pay for life and car cover. Insurers sit on huge reserves, and private credit promises them a fatter yield. That fatter yield is the bait on the whole hook. Third, family offices and endowments. The money of the very rich universities. They can lock money away for years, chasing bigger returns. And now, quietly, they're opening these funds to everyday investors like you. So the money is not really hidden. It's woven through your whole financial life, which raises a scarier question. Why do they all want in? Follow the incentive, and the whole thing suddenly makes sense. For years, safe bonds paid almost nothing. Big investors were starving for years. Private credit dangled double-digit returns, and the whole crowd rushed toward it. But higher return always means higher risk. Always, no exceptions. There's a second lure. These loans don't trade daily, so prices never seem to move. On paper, it looks calm and smooth, while stocks swing wildly next door. That smoothness is not safety. It's just a value nobody has checked lately. We've seen this calm before. It ended in 2008. Let's put 2008 and today side by side, right here. In 2008, banks made risky home loans and sold them everywhere. Those loans were sliced, repackaged, and stamped safe by the rating agencies. When homeowners stopped paying, the whole tower came crashing down at once. Today, the risky loans went to companies, not homes. And they didn't go through banks. They went through funds regulators barely watch. Same idea, new costume. Move the risk to where the rules can't reach. So is this safer than last time, or just quieter? Defenders say funds use long-term money, so they can't face a bank run. That's fair, but three things still worry me deeply. Here are 3 reasons this could be worse than 2008. Reason 1, regulation. After 2008, we finally put fences around the banks. But this market grew outside those fences, with far lighter oversight, on purpose. Fewer rules feels great. Reason 2, transparency. These loans are valued by the very funds that own them. It's like grading your own homework, then telling everyone you passed with a smile. When the truth finally shows up, it tends to arrive fast. Reason 3, connection. Pensions and insurers are wired straight, so a crack over there can reach your pension and your policy over here. That's the real point. This isn't their problem. It quietly became yours. So let's tie it together. The money came from you all along. Pensions, insurers, and endowments chased yield into a market with almost no rules. It rhymes with 2008, but with dimmer lights and much thinner fences. You don't need to panic, you just need to see it. Watch 2 signals: how fast these funds grow and who they let in. At The Simple Coin, we follow the money so it never surprises you. Subscribe.